Well, hello everybody. Hopefully this finds you all well. It is August the 11th and I'm doing the market update. And there is a lot to talk about because we're in basically a critical pivot point right now for the economy, and obviously it affects housing as well. So basically what I wanted to talk about is the general real estate market, and then how the interest rates change, or the change in the Fed and the Bank of Canada's position regarding interest rates may affect the housing prices. So there's a few things to go over here, so bear with me. It might be a little bit longer than normal. Now, one of the things that I really wanted to talk about is that, as you know, housing prices are extremely affected by interest rates. Now, the Fed and Bank of Canada has been saying they're going to continue to raise interest rates to battle inflation. Now, the consumer price index came out and it showed that the inflation rate was currently at 8.5% across the United States. Now, that is the same with zero change over the previous month. So I'm speculating that at this point, what the Fed is going to say is, now that our efforts have stalled the inflation, we are now able to go on a softer path to increasing rates. I don't think they're going to stop increasing rates. I don't think that the Fed wants the opportunity, wants to be somebody who goes back on what they said they were going to need to do. So if they pivot too quickly, world figures will see them as being out of control, and people will lose faith in the American economy as they're losing it right now, but even more faith, and that would cause a massive problem. So the only way the government can deal with that is to slow down. So I believe that Powell's basic pretense will be, hey, look, guys, what we've been doing in raising the interest rate has now stalled inflation, which has done exactly what we set out to do. And we don't want it to get away from us again. So we're going to do another 0.5 interest rate hike, and then possibly another 0.25 by the end of the year, which gets them exactly on the target of 3.75 increase over the year that they originally set out to do. So given that as the backdrop, how does that impact housing? Well, right now we're at the point where all of the variable rate mortgages are going to be at a point where we get over 5%. And at that point, we're going to have a reset on a lot of people's mortgages. So what ends up happening is the variable rate mortgage is set so that a lot of people have it set anyways, so that their monthly payments remain the same even though the rate changes. And what that means is they're paying more interest payments and less on their principal. But it gets to a point where the payment that they're making is all interest, and the banks can't have that. They need them to be paying down some of their principal. So there's a trigger rate, and that trigger rate is going to happen probably with the next interest rate hike. And when that occurs, the banks are going to start sending letters to people saying, hey, just so you know, your payment that was $3,500 a month has now gone to $3,800 a month to compensate for the fact that interest rates have changed so dramatically that we need to make a change. So that's going to have a major impact on people's buying power. To give you an idea of what the buying power impact is, the fact that we went from 2.5 to 5%, we've basically doubled the mortgage rate. What that's done is that has an effective buying power of a buyer reduced by 25%. And that has essentially caused about a 10 to 15% price reduction in the market. And what we're seeing is homes that used to sell, we've seen it recently on some of our listings, homes that were selling for 1.2 million are now selling for 1.05, 1.075. So they're dropping by about 10, 11% from the highs. So we're definitely in the line where that's what's got to happen. So keep that in mind when you're looking at the statistics and we're going through that. The other thing I wanted to mention as well as just a statistic thing before we get into the actual housing market is that there's a report out today that Hootsuite is going to be reducing their labor force by 30%. Apple has already reduced their labor force. Google reduced their labor force. And what we're finding now is that the labor force reductions are getting greater. I did look up, I'm just going to look up this number to make sure. But it was the wager, on the CPI print. I looked at the Canadian report for housing starts, and housing starts have leveled off and tapered off a little bit. They're down like 1.4%, which is not a massive deal. But when the permits start to come in lower, that's usually an indication that we're headed into a recession. And we actually had a negative wage growth. So the wage per hour actually declined on average in Canada last month. So what that implies is that the higher wage jobs are not there and the lower wage jobs are there. And the rate of employment actually decreased a tiny bit as well. So that's going to again have a major impact on the buying power. The question is, at what point are we going to reach the level where there's a financial crisis? When we already know that the governments of the world are all in massive debt. I mean, the amount of debt held by the governments of the world and also held by individuals is the biggest it's ever been. And so we're now at a point where, as these interest rate hikes start to take effect, they're having a massive impact on people's ability to spend, which is what is actually curtailing inflation. Because as people can't spend as much because they don't have as much money because the interest rates have gone up, as a result, then you're seeing things like the ability to buy anything is going down, which creates a lower demand, which slows down inflation. So that's exactly what's happening right now. What you also have to remember is, as housing prices come down, this is where the second sort of nail in the coffin comes in, where we have most Canadians, their equity is tied up in their home. So when their home goes up in value, they're like, great, I've got an extra $20, $50, $100,000 that I can spend doing a renovation or spend doing something that I'd like to do, go on a vacation. And so they feel that ability to spend, and they do spend. When that gets taken away from them, they instantly don't feel as though they can spend. And the things that they spent money on, if they borrowed them against their house, the rate goes up and it's actually costing them more for things that they've done in the past, but not things they're contributing to the economy right now. So that's a bit of a bleak look, but do understand that the Fed and the Bank of Canada is going to scale back what they're doing, but typically they're going to be about 6 months behind. They're always backward looking. They always look back to see the data in the past, to see where it was, and therefore this is the policy we need to create. They never look forward and to see what's actually coming. And that's kind of the tricky situation, is where do we see what's actually happening and what the Fed is going to do based on the past information that they're working with, or the Bank of Canada based on past information they're working with. So sorry that was a little bit long-winded. I'm just going to check my list to make sure I did go over everything. And yeah, it looks like I did. The only other thing that we're going to talk about is that we're seeing steep corrections in both Vancouver and Toronto as well in housing prices. So when we do that, you'll see here the chart that I've got open, and it's a great lead right into the housing market. As you can see here, we've talked about this before. This is the HPI price index. Now that is always a 6-month lagging indicator, because when prices typically get posted, the price gets posted and it takes a while for them to incorporate it into the housing price index. Now, when we see this, we've seen basically a 5% drop from here to here. That's obviously lagging, so we're going to see another 10 or 15% come off of there. And notice the last time that we had this sort of rollover on the HPI. Now this is the monthly. I told you about this before. We always have to watch the rolling index for confirmation. But this is sort of an indicator of where we're going to go. You can see how it climbed up here and then it rolled over. Now it did have a little bit of a recovery, but then it rolled back over again. And total down here was about 17% decline from 2018 down to 2019. It is a little bit different in Squamish, and I've said that before, that things are a little bit different. Now in Squamish, you can see here, we didn't quite go down as much, even on a monthly basis, as Vancouver did, and we're just starting to roll over here on the monthly. Now, if I shorten that up to 3 years, you can see again, we've rolled over a little bit. The challenge is we don't have as much data, and as a result of not having that data come in, we tend to not be accurately reporting what's happening in the market. So just kind of keep that in mind. Now, when I change it to the rolling 12-month average, you can see here there's not very much of a change. I mean, the market skyrocketed up, but you can see a gradual rollover. When that actually starts to roll over, that will be the first indication that, yes, we're definitely into a bear market in the housing prices. And we could go back and it could roll a little bit and then take off. But once we see it actually turn negative, that's a big concern and something we have to sort of pay attention to as time goes by. So again, some of the key components of the market that we look at, one of the biggest ones is the sales to active ratio. And as you can see, it's rolling over on the 12-month, which is a massive indicator that things are not looking great. And there on the monthly, we've come down from an extreme seller's market, as most of you know it was back at the beginning of this year and the year prior. We've come down below 2. We're down at 1.13. Now, if I extend that out for 5 years, you can see we're down near the lows. So here's 0.13 in July. Here's 0.110 in May of 2000 and 0.07. I wouldn't be surprised if we take out the lows and we get to historic lows. Vancouver is at historic low volume of sales over the last 20 years. They're sort of the third lowest they've ever been in 20 years. And that's a benchmark over 3 months. There has to be 3 consecutive months of volume of sales down that low. And considering we've got population growth and there's been more building, to have a number that low is pretty indicative of what's going on. Buyers are not pulling the trigger. They're holding back. And at this point, kind of rightfully so. So the sales to active ratio is a huge change. And we can go back even as far as 10 years and you can see here how low we are. We stayed low in here when the market was the hottest it's ever been. The hottest it's ever been was right there. And then we had a settling period here. And that was when the market was a little bit more stagnant. So keep that in mind when you're looking at everything that we're looking at here. I'm going to quickly go through this. Sales have fallen off, as we talked about. New listings. Now, new listings peaked here. We are seeing new listings come on faster than sales, and that's why the sales to active ratio has declined so much. But new listings are still coming on at a fairly rapid rate. Total inventory is rising. You can see we're up at 204. I thought we might get to about 230 or 250 by the end of the summer. Not sure that we're going to actually get there, but if we do get into a 230, 250 for listings, I think that's a really good indication we're going to see some softening in the prices. So keep that in mind. There's our first indication of the actual softening in prices here on the monthly. I'm going to change this back to 3 years. It's easier to see. You can see the softening. And when we look at the stock market, we're always looking for a takeout of a lower low. So here you can see, even when this was a low, when you reach the next level, it was a higher low. And here, this low is a higher low than that low. Now when you come here, we get this lower low or higher low, and then we had a higher low again, but now we've taken that out with a lower low. That is a big telling feature. So price per square foot, that's what we're looking at right there. But if we look at HPI, or let's look at the sales price, you can see here, we did take out a lower low and we're not going to create a higher high. So because you're not going to create a higher high and you're going to actually get a lower high, the next will be to take out that lower low. So we're going to continue on that trend there. HPI, there we go. HPI price index, this is where we start getting into it. It's going to roll over. Now, as soon as it gets to the 1175700 level, we're instantly creating a lower low. And when that happens, all bets are off the table and we're going to see things start to slide a little bit. Everything else, I think, is pretty much what you've seen. I think we understand where we're at. The question is, where is it going to go? How quick will the Fed and the Bank of Canada pivot? And will buyers come back to the table? I will say that I know that prices in the Fraser Valley and area have gone down 15 to 20% in some cases. So we're doing better than they are, which is fairly standard for Squamish. Squamish typically does better than a lot of people. And I've also been in touch with a few people in the banking world, and I understand that the mortgage applications have fallen dramatically. In fact, CIBC down in Vancouver, one of their branches, they had 0 applications for mortgages, 0 approved applications for mortgages actually in the month of July. So that's again another telling feature. So something we want to keep in mind. Where we go from here, and it really is anybody's guess. I mean, the Fed can do whatever the Fed can do, and the Bank of Canada is going to follow suit with that. The only thing I've said before is that we are very, very affected by our housing market, much more than the States. And as a result, Canada has to be a little bit more in tune with their interest rate developments, even though they don't just affect the housing market, but they affect the economy as a whole. So that's where we're at. I think it's something to be aware of. Prices are starting to fall. We're starting to see some slipping in the prices in general. We are starting to see a lot of new listings come in relative to the number of sales, and especially for the summer. So I hope that finds you all well, and I hope that's been helpful. If you have any further questions at all, feel free to contact me anytime. I'm happy to answer any questions that I can for you. Whether or not now is a great time to buy or sell, happy to answer that. Again, I mean, my general opinion is buyers are always best time to buy is when you find the right place. That's always the best time to buy. Sellers, You're going to have to be creative with the way that we market your home. We're going to have to be creative with the way you price your home too, because there's a lot of competition out there. There's been more competition out there with new listings hitting the market than there ever has been. But at the same token, prices are still high relative to the previous 2-year average. They're falling a little bit, but they're still high relative to the 2-year average. So keep in mind that if you've owned your house for 3 years, 4 years, 5 years, you're still doing exceptionally well. Maybe you didn't catch the peak, but you're still doing well. All right, hope that's good. Thanks very much, guys, and have a wonderful rest of your summer. Bye for now.